Hi guys, I'm Karunya Rao and in Ideas for Profit, all eyes on HDFC Bank. Now the lender posted a strong performance with net profit rising by 18% year-on-year in the second quarter of FY22. Profit growth was healthy despite higher operating expenses, stable margins and accelerated provision during the quarter. So then what was the key driver of Q2 earnings? A strong pickup in business momentum underlined HDFC Bank's performance this time around. Being impacted by the pandemic in the past year, the two big issues confronting the banking industry today are growth and asset quality. Remarkably, HDFC Bank scored well on both these parameters. Loan growth of 15% year-on-year and deposit growth of 14% year-on-year stood way above the banking industry's loan and deposit growth of around 6% and 9% respectively for Q2. This implies that HDFC Bank is gaining market share at an accelerated pace, notwithstanding its huge size. Festive demand in the coming months is likely to drive further business growth, especially in the retail segment. While the restructured assets of the bank increased to 1.5% at September end from 0.8% at June end, the overall asset quality of the bank remains under check and superior to peer group. Slippages moderated, collections improved and GNPAs declined during Q2. The biggest comfort on asset quality front is the excess provisioning. HDFC Bank held floating provision of 1,451 crores and contingent provision of 7,756 crores as of September end. Cumulative additional provisions works out to be around 0.8% of advances and equips the bank to deal with future exigencies. Despite a resilient performance in the pandemic year, HDFC Bank has underperformed the broader benchmark in the recent times. While Nifty has rallied 31% year to date, HDFC Bank stock has been a laggard and has risen by a mere 18% in the same period. The underperformance is stark when compared to peers. The adverse impact on margins because of higher corporate lending over past many quarters, along with RBI's restriction on credit card and digital businesses, has weighed on the stock performance. With the ebbing of the virus risk and increase in economic activity, we expect a gradual improvement in margins as retail and SME growth overtakes the growth in corporate advances over the coming quarters. Also, HDFC Bank has turned aggressive in credit card business with partial lifting of embargo in August. In the last 5 weeks of Q2, the bank issued over 400,000 credit cards and expects to make up for the loss in the market share in credit card business in the coming period. HDFC Bank reported total advances of 11.98 lakh crore in Q2, a healthy increase of 15% over last year, led by commercial and rural banking loans. Wholesale loan growth was subdued at 6% YOY in the absence of much of capex demand. Retail advances grew by 13% YOY on the back of strong demand in mortgages, gold loans and personal loans. Good traction was also seen in vehicle financing book as well. Growth in deposits was strong at 14% YOY. CASA ratio increased to 47% of deposits, an improvement of 520 basis points year-on-year. Despite robust growth in CASA deposits, NIMs remain steady at 4.1%. The management expects margins to improve with acceleration of retail growth. Fee income also showed a rise of 26% YOY as business activities bounced back during the quarter. Slippage ratio declined to 1.8% in Q2 FY22 from 2.5% in Q1 of FY22. Restructured assets inched up, led by personal loan segment. Management sees maximum 10 or 20 basis points impact of restructure book on NPAs. Provision coverage ratio increased to 71%, an improvement of 300 basis points over the June end quarter as NPAs declined. HDB Financial Services, which is a subsidiary of the bank, posted better performance in Q2. While the loan book remained flat on a YOY basis, the lender reported a profit of 192 crores in Q2 compared to a loss of 85 crores in the same quarter last year. Meanwhile, HDFC Securities reported a very strong set of numbers with profit rising by 44% on buoyant capital market activities. At the current market price, HDFC Bank is trading at 3.2 times core book value estimated for FY23, assuming conservative earnings growth of 12% CAGR over the next 2 years. Its valuation is at a discount to historical long-term average multiple. This implies that the street is extrapolating temporary issues as long-term concerns, which we think is unreasonable and presents an opportunity to buy. As the street starts looking past the bank's digital troubles and shifts focus to consistent show, the underperformance of the stock is likely to reverse. We see the promising growth outlook to outweigh near-term concerns on margins and uptick in restructured book. Given the ROA of above 1.9% and ROE of 16 to 19%, valuations can revert to above historical mean levels, which along with earnings growth can lead to meaningful upside in the stock price over the next year. While it has underperformed so far, HDFC Bank stock may prove to be a dark horse for the coming year.